Hello and welcome to another episode of the Finrestra podcast. I am Jan Muschot. This is another emergency podcast episode. I am recording this on Sunday, March 19th at 5 p.m. Central European Time. And this weekend there are meetings in Switzerland about the fate of Credit Suisse. So, after the collapse of Silicon Valley Bank and the publication of the annual report of Credit Suisse, it became clear that also Credit Suisse is dealing with a lot of outflows from deposits. And the Swiss National Bank announced last week that it would open up to 50 billion Swiss franc in loans to Credit Suisse. But it seems that over the weekend, the Swiss authorities are looking for another partner to take over Credit Suisse. And on Friday, there were rumors that maybe Credit Suisse would be split up with the local Swiss business going to the Swiss Raiffeisen Bank and Zürcher Kantonalbank, if I'm not mistaken. And then quickly it seemed that that deal was off the table. And then since Saturday, there are negotiations with UBS, the other Swiss global systemically important bank. At one point, there was also a rumor that BlackRock was interested in Credit Suisse, but then that rumor was denied. And so, based on reports, UBS had proposed to take over Credit Suisse for 1 billion francs. So compared to last Friday's market cap at close was about 7 or 8 billion franc for Credit Suisse. And what's quite stunning is that according to the figures in the 2022 annual report of Credit Suisse, it reported to have a book value of the equity of over 40 billion Swiss francs, which is almost, but a little less than 50 billion US dollars. So it's quite stunning how quickly things are moving the last 2 weeks. And of course, banks, they need the confidence of investors, but mostly depositors. And after all of the scandals and the nickname of Debit Suisse, it seems that depositors have finally lost faith in the bank. And so there were already huge outflows in the fourth quarter of last year when deposits at Credit Suisse dropped by more than 100 billion. And unlike Silicon Valley Bank, Credit Suisse actually managed to pay out these outflows without compromising the book value. So it seems that they were better at asset liability management. So they had plenty of liquid assets that they could sell. However, a bank needs some kind of funding, and at a certain point, you do run out of high quality liquid assets. And also, if you cannot fund, then you have to go begging to either other banks or the national bank. And I read somewhere that there were outflows last week of more than 10 billion per day. So that's probably why they wanted to have the credit facility at the Swiss National Bank. But the question is now, is any party interested in Credit Suisse? So even for UBS, although on paper it seems like a bargain if they could have 40 billion in book value for maybe 1 billion franc, that means that they have a huge badwill, which means that in theory this should be a hugely profitable situation. Although, of course, if you lose the confidence of your clients, then it's not clear if just by announcing a acquisition by a better capitalized and more profitable competitor will restore confidence. And I guess that UBS is driving a hard bargain because they don't really want the merger, given all the bad connotation to their neighbor Credit Suisse. So we'll see. Some news wire said also that the 1 billion takeover was off the table and Credit Suisse would actually be nationalized by the Swiss. So we'll have to see, and maybe by the time you're listening, there's been a solution announced. So that's the Swiss saga. Then maybe I should come back to what's happened in the US last week. Silicon Valley Bank failed a week ago, but depositors could access their money already at the beginning of last week, thanks to the FDIC. And US authorities also pretty much guaranteed all deposits at American banks. So not just those deposits below the 250,000 limit of the deposit guarantee. Basically, if you're a startup or whatever depositor with more cash at the bank, then to prevent any future bank runs, authorities have announced to make sure that everybody would get their money. And another thing that the Federal Reserve did was to make sure that banks could borrow money at the discount window at par. So usually for a bank, if they want to borrow cash at the Federal Reserve, so at the central bank, they need to post collateral. And the collateral is usually securities like bonds. But as we know, when interest rates go up, the price of bonds goes down. And so for a nominal value of $100, maybe the market value of the bond is only $80. And that means you can only borrow $80 or less with that collateral. But due to a change made by the Fed, banks would now be able to use the collateral at par value, so at the full 100 cents on the dollar to borrow any cash if they need it. For example, because clients are transferring their money to other banks, then the banks could easily raise cash, not by selling their bond portfolios at a loss, which is what killed Silicon Valley Bank, but now they could easily borrow money from the Fed until things calm down. There was also some kind of rescue by a couple of large US banks for the First Republic Bank, which also saw a bank run and a loss in stock price. And banks have deposited $30 billion at First Republic Bank, but the market price on Friday still went down. So we'll have to see by Monday how markets react to that. So we've discussed the Swiss situation with Credit Suisse, the situation in the US, and then finally I briefly want to talk about the euro area. So there haven't been big problems reported for bank runs at European banks. In principle, the single supervisory mechanism of the European Central Bank is more strict than the regulation at, for example, Silicon Valley Bank. So for my European listeners, Silicon Valley Bank, with a balance sheet total of about 200 billion, is comparable in size to European banks like Belfius in Belgium or Helaba in Germany. Also some other banks like Banco BPM in Italy, for example. So they all have balance sheets about 200 billion. So all of these banks are subject to banking supervision that looks at things like the stable funding of banks and the liquidity coverage ratio. And even much smaller banks are also subject to those regulations. So that means that in principle, European banks should be able to withstand easily the type of interest rate shocks that killed Silicon Valley Bank. Frankly, at this moment in time, I don't see huge problems at euro area banks. Although, of course, if there's a massive bank run or depositors are freaking out, nobody knows what could happen. but I do have some confidence in the stability of euro area banks. So that's it for Sunday. So we'll see tomorrow on Monday how things turn out at Credit Suisse, and also if markets will stabilize. So this was another emergency episode of the Finrestra podcast. You can find me on Twitter at Jan Muschot, that's at JANMUSSCHOOT. Thanks a lot for listening, and till next time.